Portfolio Builder members, welcome to your weekend briefing. I'm going to review our track records, which I've just updated, as well as some market predictions, some charts, and the top news. So the big picture is in the past 13 months, with only $1 of risk, which was only lost in July, we've generated $14.58 of profit. So if you're looking to generate safe returns with low volatility, I don't think you're going to find a better track record than this right here. If you're a buy and hold investor, if you go back to just September of 2018, you hung on to nearly a 25% loss in your portfolio to gain from that point about 10% over the last 18 months. So you've been hanging on to a whole lot of volatility for what? There's a better way to play the markets, and I'm going to show you how to do that right here. Now, ever since July, when we took the only loss in our portfolio in a closed month of negative 1%, I was concerned that the trade war may escalate. From my point of view, if Trump really wanted to come out with a win in the trade war and the Chinese were not willing to purchase agricultural products, which is exactly what they promised us in July just 6 months ago, then Trump really had to put the pressure on now in 2019 so that he could make a victory and remove the tariffs by 2020 to avoid putting the U.S. in a recession. No president has been reelected during a recession. Now, supposedly we've got a deal on both sides. They're going to send Liu He to sign the trade deal in January. And they're already starting to remove tariffs to allow their businesses to start purchasing agricultural products. So the coast does seem clear on that front. And at the same time, we have 3 out of the 4 major economies dramatically increasing their balance sheets. So every time this has happened in history, the results are very repetitive. Stocks go up and the yield curve steepens. The yield curve steepens so far that it eventually crashes stocks and causes the Fed to lower interest rates. And then you get the exact flip-flop. You get all the money fleeing out of stocks into bonds that are appreciating. So that's exactly what I think will occur, is a huge stock rally towards November of 2020 with rates going up, 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 which means bond prices crash. And so that's our play. We're going to be able to profit very substantially if this prediction is correct. And I just don't see anything getting in the way of it except for either, number one, China just will not purchase any agricultural products. And at this point, I don't think that's in their cards. They're noticing that the Democrats have now turned ugly on China as well, if you listen to the latest Democratic debate. 2, we have a massive spending bill just signed this week, which practically ensures that we have positive GDP growth into 2020. There's a big tax cut potentially in the cards for payroll, which will dramatically increase spending. So all of this is just looking towards equities flying higher. Interest rates are at super low levels. We're doing quantitative easing in 3 of the 4 major central banks. And at the same time, all the bond investors overseas who are holding low or negative yielding debt are going to be underwater and fleeing from those assets going into 2020 as they realize the Fed is going to remain at the 1.75 interest rate level and save their ammunition for the next crisis. So that's what we're thinking is going to happen. Let's take a look at how our portfolio is designed. Essentially, we have 40% in the SPY, 10% in emerging markets ETF, 40% in the TLT, and another 10% in GDX. So we have a very well-balanced portfolio. However, we do use the option market to own the underlying asset and be able to profit in multiple directions. So currently, we're betting up on the SPY and emerging markets, and I suspect that will last till most likely yields on the 10-year get around 2.8, so they have considerable room to go higher at this point. And I think it will rise, but at a slower pace than many people believe, because there's going to be a lot of emerging market debt rotating out of their bonds into U.S. bonds that actually have a attractive yield compared to the rest of the world. On the other side, we'll be betting down on TLT, and I'm going to be relatively flat on GDX. I think GDX might surprise us in 2020, but I do believe the next big, I'm going to scroll down to our precious metals returns. I think the next big returns we're going to see like we did in February, March, April, and May, where we just racked up some insane profits of 21%, 10%, 26%, 60%. Those are most likely going to coincide when we don't do QE light, where the Fed's buying the front end of the Treasury. Most likely this will be an event towards the end of 2020 when stocks are crashing because yields have gotten so high and they need to get the credit market in check. So what will they do? Lower interest rates and start buying the middle and long end of the Treasury. So we might see gold either go flat, slightly down, or drift up. Maybe not a lot of volatility until those actions are at least being predicted by the market in the near term. So when we do see the Fed cut rates to zero and start purchasing the middle and long end of the Treasury curve, that's when I think we could see some substantial gains in our GDX position. So I'm willing to essentially buy a put option to protect any downside risk and have relatively flat returns on this position until it just rockets higher. And that's what I think will come at a moment's notice, and most likely we'll see the prices start to gap higher and higher overnight, making it very hard to day trade that or just jump into it. Okay, so let's take a look at our returns. The SPY has been doing very well since October when Trump said he had a phase one deal. I was still betting up on bonds in case it did not go through. If it did not go through, we had tight put option protection in case the SPY crashed, and we were pretty much just sitting for the TLT to jump higher on trade war fears and a slowdown in China, which may crash below 6% GDP into 2020. Almost surely it will. In emerging markets, there's a lot of problems, certainly in China, mainly in their real estate markets, which are highly overvalued. But without the pressure from the U.S. and actually the support of the U.S. to gain access to more and more capital, I just look at China kind of like your daughter who has a bad spending habit. She should be out of credit by now, but we just gave her a brand new credit card. So she's probably not going to go bankrupt just yet. That big play might come to us in 2021 when Trump is reelected, if he's reelected, and wants to go into phase 2 and phase 3 of the trade war, which involves China really changing the way its government operates and is highly unlikely to occur. So with that said, I do think emerging markets will do extremely well in 2020 and potentially outperform the U.S. Now, the key thing to watch for that will be the dollar slightly weakening, which would make sense. We have record deficits. We have cash flooding into treasuries that currently no one wants, although I do think as yields rise, we're going to be able to naturally attract foreign investment once again and cause havoc on foreign bond markets. And so that is why I am constructive and long in our emerging markets portfolio. Okay, the bond portfolio, we are short the TLT with our inverted option collar. So once again, we still own the asset. We sell an in-the-money call to purchase an in-the-money put. It's a very clever, safe, and efficient way to profit from a downward move in the TLT. My target on the TLT is most likely around 120. So that will still be a higher low than the previous low. And after that, my anticipation is near November of 2020, right around the election, perhaps right after the election. I believe bonds are going to be extremely cheap with high yields and set for the Fed to come in and lower interest rates down to zero and start buying the middle and long end of the Treasury because our primary dealers are just running out of cash. They cannot afford to keep buying these treasuries, and they're afraid to sell them into the market because it might make the yields pop. So instead, they're hoarding them, they're creating the repo madness, and they're expecting the Fed to eventually drop rates to zero and to purchase these bonds so that they never hit the open market, period. So I think our high target for TLT will be around 180. Now, the biggest thing to look for, will the ECB or Germany go into negative territory as we see credit markets start to get in trouble, most likely in late 2020 or into 2021. If that's the case, the US could push rates slightly negative as well and drive us past that 180 target. Now, once we get to that level, it's going to be complete mania with melt-ups and meltdowns all around the globe because money will essentially be free. And this is going to Japanify the US economy. Now, hopefully, our Jerome Powell will have the guts to hike interest rates and really fix the internal problems of how our economy is operating. But we'll see if that really happens or if they wait for runaway inflation. Now, trying to predict when the inflation will make it out of these bubbles and hit our real economy is difficult, but that's the big picture for why we want to own gold. Okay, so I have the TLT chart. My expectation is once again to form a low that's somewhere around 120, at the lowest 115. I do not think it'll go below this low in 2018. Now, once it gets near that point, the return on purchasing treasuries will be greater than the rate of inflation, and that's a guaranteed profit for banks. This makes the stock market sell off like clockwork as money floods out of stocks into an almost risk-free guaranteed profit in treasuries. And every time that happens, we also see the Fed come in there and lower interest rates so that they can prop the stock market back up and fix the yields on the bonds. Okay, so that's what I expect is going to happen, a crash in the TLT. And this is, again, as long as China's playing nice, then a 2020 end-of-year move where rates get so expensive it crashes stocks, Fed comes in, says we're going to cut rates to zero, and begins real QE. And that's where we could see this leapfrog towards that 180 target. Now, if we go into negative rates, which they say they will not do at this point, but I don't believe them because we can see they're positively talking about what the ECB has done in their most recent Fed minutes. The target could be slightly higher than 180 if that's the case. On the SPY, traditional measurements of valuation are completely out the window. We're in a world of money flows and artificial intelligence, and all they care about is how they can manipulate the market. And my expectation is with central banks increasing the money supply in 3 of the 4 largest banks, it's a pretty much guaranteed solution to rise equity prices and steepen the yield curve on bonds. It's only when they cut interest rates that we can see both stocks and bonds go up at the same time. But right now, that's not in the cards. What they're indicating is they will keep rates flat for much of 2020. And so until yields do get too expensive and crash equity markets, I don't think the Fed will change anything except for supporting the bond market with purchases. So when you add central banks financing the bond market, massive government debt, which is going to show up as positive GDP for corporations, tax cuts on payroll, and a massive flood of money getting out of negative yielding debts, that points to a massive bull run into 2020. What's the potential return? Probably somewhere between 10 and 30% before we hit November and cause yields to get ultra attractive. Okay, so let's look at the yield curve. Here's what I want to point out. If we go back to the last stock market crash we had, which was starting in September of 2018, in October is when this crashed, you can see what happened is the 10-year yield hit 3.05%. And if inflation's supposedly at 1.7, banks can almost double their money and leverage up on that all day long. And you better bet they're going to leap on that every time they get the chance because they know 2 things. Number 1, they know that's going to cause stocks to crash, which is going to cause a flood of money into bonds. Number two, they know the interest rate that they're going to grab on that is a guaranteed profit. And number three, they know that the Fed's most likely to come in and cut interest rates to drive those yields lower so that they can keep equity prices afloat. So that means the bond price doesn't just generate a guaranteed profit on the yield. They'll be able to flip that bond for a huge profit and buy stocks at a cheap price. So that's exactly what played out in 2018. If I do add a couple more points, let's check out where it got to in October. It went even higher, and this just totally clobbered the stock market. Clobbered it even higher, and then by December, we saw that so much money was flooding into bonds and selling out of stocks, it was naturally being pulled lower. What's happened since then? In 2019, the Fed came in and started light QE on the front end of the curve. So you can see it's just dragged these interest rates on your short-term debt all the way down to 1.5. Meanwhile, the long end is floating like a kite, wanting to shoot off into higher yields, only being supported by this weight of money, which is $60 billion a month purchasing this short-term debt. So my expectation is that stocks will continue to rally and that this portion of the yield curve is going to slowly hike back up to where it was in September of 2018, where we crashed the markets. Now, I do believe the market's more leveraged today than it was then. In fact, clearly it's much more leveraged. So I don't think the yields can get anywhere near as high as they did in 2018 before it will create an adverse effect on the stock market. So that's really the key items I'm watching to predict markets at this point in time. Now I'm going to review our strategy. Also, here's our disclaimer if you want to give that a read before we go through our entire strategy A to Z here, so you can see how the big picture works when you follow Portfolio Builder's daily trade alerts. The easy way to predict markets and generate safe income. Daily income trade alerts at noon Eastern. Here's our trading plan. Our goal is to generate a 1% return per month. We're 50% equities, 40% bonds, 10% gold. However, using options, we can predict that these assets travel in different directions. So sometimes we're long equities and short bonds, like we are currently. Sometimes we're long equities and long bonds, like we were all of 2019. In fact, we just switched to short bonds now that it does seem like the trade war is really coming to a truce into the election. So this breaks down to 100 shares of the SPY traded Monday, Wednesday, Friday, 200 shares of emerging markets traded on Tuesday, and then 200 shares of TLT as well as 200 shares of GDX traded on Thursday. Each trade alert is followed by a live webinar, so you can hop online, meet other people following our program, and ask me as many questions as you like while I present the current trade. The target return is 1% per month, or $750 a month per $75,000 invested. Most of our clients have a couple $100,000 to a couple $1 million following the program who really find the greatest value in our strategy. Profits in 11 of 13 months. Largest drawdown in any period is 1% in a closed month. We broke even 1 month, so we've never lost capital over a 90-day period. And we really outperform markets when the stock market's pulling back. And that's because of the nature of having put options below our underlying assets at all times and being able to use the bond market to be essentially our insurance against stock crashes. Now in May, there was a huge crash in stocks. We pulled a 2.2% return. In August, when the trade war suddenly came out of nowhere, we pulled a 0.8% return. After that surprise, when in July he told us we had a trade deal, in August he told us we didn't, I've remained long the bonds, and that's been the drag on our portfolio. You can see we've had handsome returns on stocks during the last several months, but I was betting that bonds might shoot 10% plus higher on the TLT. So we had a slow bleed. We lost about half of the returns we're making each month. trying to bet that the trade war may not actually come to fruition and that it could create another scare into bonds. Now, that did not materialize. And for the time being, I do believe that the Chinese intend to live by their agreement and to avoid more stress with the U.S. poking at China. Their reputation has been smeared, and I don't think they want any more drama in the near future. So we'll see if they do start to not make agricultural purchases. I'll be the first to turn our trade back around on the TLT so we can benefit from more upside on bonds and most likely a significant sell-off in stocks. Our simple 4 ETF portfolio is extremely diversified and all you'll need for your retirement. Income and safety, not growth or speculation. You can simplify your holdings, reduce your risk, get better results with less work, and weatherproof your retirement portfolio. So these are our 3 core trading plans at this point in time where we don't see inflation as a problem. So if the trade war is up in the air, I like to be long stocks, bonds, and relatively neutral on gold. This allows us to take a shock and benefit from the TLT and GDX, but not get killed and be able to still generate profits from the SPY and emerging markets. So that was actually what we did for almost the entire period in 2019. In 2020, we've actually switched to this setting, which is a de-escalating trade war where we're long stocks, long emerging markets, long gold, and short bonds. So this again is the go-to trading plan in a de-escalating trade war. Now, if the trade war were to escalate, we would quickly switch our trading plan to be short stocks and long bonds and gold. So those are the key things I'm keeping track of, as well as when bond yields get so attractive that they could single-handedly create a sell-off in stocks. Now, to profit from multiple directions, this is our go-to playbook here. We have the bullish loose option caller. And so you can see in this setup, we're selling an out-of-the-money call and buying an out-of-the-money put. This protects us from the downside risk with the put and generates income without holding us back from our underlying asset generating profits by appreciating. Now, if we think the asset may be at a top and is ready to crash, but maybe not just yet this moment, we're going to do a neutral tight option caller. This allows us to profit if we go up or flat and to have a very small loss if there is a sell-off. So we're selling an at-the-money call and buying a near-the-money put. Finally, we have the bearish inverted option caller. This is what we're using on the TLT until it tanks all the way down to about 120. And that is, again, as long as the Chinese play nice. So this allows us to have a loss on the underlying asset if it actually travels up. But if it travels slightly down or dramatically down, we generate a very nice, handsome profit. And we actually get a 2-to-1 risk to reward ratio. If you note on the last two, we have a 3-to-3 ratio, a 1-to-1 ratio, and only when we bet down can we get a 2-to-1 ratio. So this means we can win twice as much as we risk, and that's a very unique opportunity to bet down on bonds or stocks. So at this point in the time, we're aggressively bullish on stocks and aggressively bearish on the TLT. And this trade is designed by selling an in-the-money call and buying an in-the-money put. Now, I'll explain these in great detail in the live webinars we're hosting daily. So make sure to check your email 1 hour before the noon start time for your access link. So if you haven't caught on by now, the number one thing I'm tracking is whether the Fed's buying or selling. Right now they're buying. Number two, are they raising or lowering rates? They're flat. They're planning to stay flat until most likely yields get too expensive that they tank the stock market. So that's what I'm looking out for on that. And then three, is inflation a concern? At this point, it's just not. They're not worried about inflation, and they're telling us they're going to allow it to run hot. That's great news. That means gold is going to rocket higher as we start to see real signs of inflation, and the Fed refuses to react to it by raising interest rates. In fact, we know the Fed wants to do nothing other than slowly as possibly lower interest rates to zero and to continue purchasing up debt from the primary dealers who are purchasing all of the government's debt. All right, guys, that's a good update for today. I will put up a phone number to call Dean for a special deal. We have sent out a special offer via text message this weekend. If you call Dean at 505-322-7515, it's better than what we're putting on this screen right now. We have some 30% and 40% discount codes for a few lucky subscribers depending on which product you're purchasing. So thank you so much for taking your time to review this track record video today. I'll be updating this every weekend and getting it out to you on top of our normal Monday through Friday trade alerts. So call Dean right now, grab those discounts. We only have a few spots left. 505-322-7515.